It's wondering why the SPY and the market is running the way it is. Well, like I've been saying for the past few months now, actually several months, there is a problem for the industry. And that problem comes and stems from the Fed policy market operations. And we're, of course, talking about the repo. Now, what is a repo? It's basically a two-way intersection for cash and collateral to be transacted. Now, what's different about this is that the Fed is currently sitting in as the lender of last resort, clearing for the big participants. Now, this is the issue. The banks are incentivized to push and put all of their shares inside the money market funds like Fidelity, BlackRock, Vanguard. That's where all the shares are. Now, these shares and assets are then given to, or cash rather, are given to the Fed. So, in essence, the Fed has the cash, the money market funds have the treasuries and the assets, as reflected in their reports. Now, this is the issue. The repo is trapped volatility. And as you can see here, there's never been a period in history greater in demand than right now. That's because this is essentially a bail-in, and this is record amounts of cash in the system with markets pushing, their relative lows. So if you don't think they're going to inflict as much pain as humanly possible, only to inject all of this back into the system at the last minute, you may be reading social media too much. So, that being said, there has been some developments regarding the FDIC, which covers insurance. SIPC is for stocks, but this is relevant to banks because this is an advance notice out of the Federal Deposit Insurance Corporation, and it is titled Resolution Relating Resource Requirements for Large Banking Organizations. The summary of this, and this is an advanced notice, by the way, the Board of Governors of the FDIC and the Federal Reserve System, together, the agencies are publishing for public comment this advanced notice of proposed rulemaking to solicit public input regarding whether an extra layer of loss-absorbing capacity could improve optionally in resolving a large banking organization or its insured depository institution and the costs and benefits of such a requirement. This may, among other things, address financial stability by limiting contagion risk through the reduction in the likelihood of uninsured depositors suffering loss, and keep various resolution options open for the FDIC to resolve a firm in a way that minimizes the long-term risk to financial stability and preserves optionality. The agencies are seeking comment on all aspects of this, of the ANPR, from all interested parties. So if you would like to send a comment, you are able to do so. Now, the background. Over the past decade, the Board of Governors of the Fed Reserve System and the FDIC have promulgated rules and guidance, both jointly and individually, to support the orderly resolution of a large banking organization. These rules and related guidance are tiered based on the complexity and risks of the banking organizations. The most stringent rules apply only to global, systematically important banking holding companies, or GSIBs, and include requirements to submit a resolution plan every 2 years, follow a clean holding company requirement that prohibits top-tier holding companies from entering certain financial arrangements that might impede orderly resolution, adopt resolution-related stay provisions in qualified financial contracts, for example, establishing a set period of time during which a party to a qualified financial contract is restricted from terminating, liquidating, or netting such contract in the event of resolution, and maintain minimum outstanding amounts of total loss-absorbing capacity and long-term debt. The board has issued supervisory guidance on recovery planning that applies to GSIBs, and the FDIC has issued the rule to require certain covered depository institutions, including IDI subsidiaries of GSIBs, to periodically submit resolution plans to ensure the FDIC can effectively carry out its responsibilities for the resolution of a CIDI in the event that its appointed receiver under the Federal Deposit Insurance Act. This is some pretty big stuff. So basically what this is talking about is a resolution plan. So in the event that a large banking organization fails. Now everyone has it backwards. If banks were to fail, we are not going to crash down. We would crash up. Again, this goes back to the repo. The SFT service has still not been implemented yet, so there's no way to finance the fire sale of assets should that happen. And given the fact that the Treasury is in the hands of the money market funds and the cash is in the hands of the Fed, a crash up would be in order, considering the amount of volatility that's trapped in the repo and the amount of cash as well. So basically, the strategy for this resolution would basically be the FDIC pursues a strategy of selling the failed IDI to another depository institution. And then actually during this global financial crisis, there were limited and undesirable options available to the FDIC for resolving the largest failed IDIs, including disruptive and costly liquidation strategies or the sale of large banks to even larger institutions. So this is been proposed. It is an advance notice. If you would like to read it in full, I will link it below. But they're setting things up to catch assets in the event that something happens as far as one of these large banking organizations fails to meet their capital needs. So this is some pretty big stuff, and the timing of all this right before midterms is pretty telling. So I'll link this below, but yeah, this is pretty big. And again, this is titled, Federal Reserve Board Invites Public Comment on Advance Notice of Proposed Rulemaking to Enhance Regulators' Ability to Resolve Large Banks in an Orderly Way Should They Fail. Pretty big stuff. I would definitely take a read. And this is also, if you just happen to give up your SIPC insurance, this may be concerning to you. So I would definitely reconsider or look into that decision.